Hello, good morning. Good morning.
Morning, sir.
Yeah, you able to see the screen?
Yes, sir.
Yeah, so let us start the session today. Today we are going to discuss about some of the miscellaneous export and import related subjects. One of them is the merchant exports, because merchant export, most of the exporters may not have their own manufacturing facilities, but they do in the form of merchant exports. So they procure from the domestic market or import or whatever may fashion they want. They procure, they source the items, then they will export directly without any manufacturing activities are involved. So that is the merchant export. Then third country or merchant export we call it. So merchant export means, suppose we got an order from the US. To execute the order, we are procuring from the China, but we are not bringing to India, but from China to directly we are exporting to this US. So such transactions are called merchant exports. So those also we'll discuss. Then what is the impact and tax related impact, and how to make the transaction of the third country exports or merchant export, generally we call it. So then high seas exports. High seas exports means before it is bringing into, means making the clearance from the customs, means before filing of the bill of entry. N number of transactions we can do. Suppose we have the original, there is an importer. Before the consignment is been cleared from the customs, then the importer, the original importer, may sell to many other importer, means the business people. So in such case, what happened? Who has to pay the customs duty? That questions and other things we related on, we express all these things related questions. So that is about the high seas. High seas is very important because most of the times, for example, in coal is imported in a chartered vessel, but very high quantity of, say, 40,000 tons and 50,000 tons, like that, that is imported. But the domestic requirement of individuals may not be that much of 60,000 tons. Maybe somebody wanted 10,000 tons or 5,000 tons. Then that entire chartered vessel what's been imported, then before it is been cleared from the customs, the original importer may sell to many other businesses, and they may procure, say, part of the consignments, not total. So that is also possible, and that is through happening through high seas exports. So how that high seas transactions, and it's related the GST point of view as well as from customs point of view we'll discuss. Then again, about the deemed exports. Deemed exports means the goods are which is not crossing the Indian borders, but those are supporting the other exporters. So suppose you are supplying the goods, you are a domestic manufacturer, you are supplying the goods to a advance authorization holder or EPCC license holder or EOU. These are being treated as a deemed exports. Then how to make the transaction under deemed exports? What are the taxes applicable, and how to get the refunds, if any? So these things we'll discuss in the deemed exports. Then about the sending the samples for export business, in the trade, many times we used to send the some extra samples, because that is a part of the trade. The overseas importer or the customer always looks for some samples, and before making the business or any contract. So therefore the samples how to send and what are the regulations, that we'll discuss. Then other important aspect is about certain times we means to import the goods, but suppose the capital goods were imported, but we found these are defective. Then how to re-export, and what are the formalities, that is also we'll discuss. And then we also discuss about the, suppose we have exported, but later on those goods have been returned by our customer, then how to make the treatment. So these both we'll discuss. Then also we discuss about the project import. The project import is a very important concept, because whenever we are making some, for example, new establishments or a new project we are starting, then lot of import materials we are maybe importing, required for import. So in such case, the imports when we are making, maybe a machine we are importing, but along with machine, lot of associated accessories and other things also may be required. So all these things, how we can we have to declare, that is very important. Otherwise, individually they will make the assessment, that is very tedious and costly also at certain times. So how to make that import of the capital goods, especially project imports we call it, for the capital goods mostly. So as a one heading, it is not like a different headings, because suppose you are importing a capital goods, and some of the spares are maybe steel items, some of the spares may be plastic items, some of the spares may be rubber items, then customs will make the assessment individually each of the items under various chapter headings. Then it will be very tedious, but there is a provision is there where we can declare this as a project import. Of course, the registration and the formalities are there. Then under one heading only it will be imported. So all the means what are the n number of spares are there, but all these are covered under one single chapter heading. So therefore it is easy for assessment and make the payment also. Okay. So those details we'll discuss. So going forward with merchant exports, merchant exporter means who has not having any of his manufacturing facilities. As per the para 9.32 of the foreign trade policy, the merchant exporter means a person who export the goods manufactured by him or intends to export such goods manufactured. So that is manufacturer exporter. Sorry, that is manufacturer exporter. Manufacturer exporter means who has own his manufacturing facilities, his own manufacturing facility, who manufactures the goods and then export. That is under the para 9.32 of the foreign trade policy. But when we come to the merchant exporter, he don't have the facilities. That is covers under the para 9.33 of the foreign trade policy. That is merchant exporter who engaged in the trading activity and exporting or intending to export such goods. Means only trading goods he is doing, means he has procured from in the local market or otherwise, so then he will export the goods. That is called merchant exporter, right? And there is of course different procedures are there. My manufacturer exporters, of course, he has all his liberty, he can export as he like. But when you have a merchant exporter and you want to avail certain benefits, then you have to follow certain formalities, some procedures there. That is what we are going to now discuss. The merchant exporter in the earlier regime, means before GST, if you consider, then the merchant exporter is allowed to procure the goods within the state, for example, without making the payment of the VAT. At that time, before GST, VAT was applicable, but VAT is exempted if you provide the H form. If you provide the H form, through H form, he need not pay the VAT. So therefore, that's whenever you are procuring the merchant exporter from the domestic market, the tax is exempted. But when GST is introduced, that provision was not there. After that, lot of exporters and merchant exporters, they protested. Then government has given certain relief. That relief is, of course, we had to pay a small amount of the tax as a transaction tracking. It is required, so therefore they make small payment. Otherwise, it's almost like exempted. Like, so that special provision they made for the merchant exporters. So what is that special provision? We'll now going to discuss. So this is the notification. Under this notification, notification 40 bar 2017 and 41 bar 2017, these are the two notifications are made. Under these notifications, it was made a special provision for the merchant exporters. Under this provision, the merchant exporter must be having a GST number, means he must be registered with the GST, and also it is a mandatory that he must be registered with any of the export promotion council. He must be registered with any of the export promotion council, and he has to have a valid RCMC. Valid RCMC means registration cum membership certificate from the concerned EPC, means export promotion council or commodity boards. Okay. That is a mandatory first condition to qualify him for availing the benefit of the merchant export. So just a minute, sir. Just a minute. A call is coming. Sorry. So a merchant exporter, if he want to avail of the concessional benefit, then he must register with GST, and also he must have a valid RCMC from the concerned export promotion council or commodity board. That is first condition. Then the merchant exporter should place an order to the manufacturer, because whenever you are procuring from the domestic sourcing, then he has to place an order, and its copy shall be provided to the jurisdictional officer of the such manufacturer from where he is sourcing. Now the registered supplier, means suppose he is sourcing from the domestic market, the domestic supplier who is supplying to the merchant exporter, he can now supply the goods at concession rate of 0.1% of the IGST. In case of IGST means interstate or within the state, then he has to pay 0.05% of CGST and 0.05% of the SGST. So this is the concession they are providing. The concession is subject to certain conditions. This concession of say is a point net is 0.1%. This concession is subject to certain provisions, certain conditions. Okay. The conditions are, as I told you, the merchant exporter must be registered with GST, and also he must have the RCMC, valid RCMC, and the supplier who is making to the merchant exporter, he also must be registered person only. Okay. The goods can be directly placed to the manufacturer, and to the manufacturer can send the goods directly to the port or concerned ICT, ICD. ICD means inland customs depot or airport or any of the custom stations. So directly has to send. Also there is provision he can send also to the some warehouses where it is a warehouse. He first can warehouse, and from there also he can send the goods to the port. And also consolidation provision also given. For example, you are procuring the goods from 3-4 sources, then you want to export. In such case, the consolidation is required, means all the goods has come together, and then you have to export the goods as a merchant exporter. In such case also the provision is there. Under this provision, you see, you can aggregate the goods, means all the goods you can bring to the common warehouse, and there you all the aggregated goods can be exported and then sent to the port or ICD or airport or custom station. Then you can make the exports. Okay. So this provision also given, because certain times the merchant exporters may not be able to source entire things from one supplier, or the suppliers are maybe different items. Suppose the merchant exporter, because he has a liberty, any item he can procure from the domestic market as a trader, and then he can export. So he can be exporting n number of items. Maybe some items are manufactured by X person, some other items are manufactured by Y, and some other items are manufactured by Z person. So he can bring all these things to a common warehouse, and there from he had to aggregate, then send to the port. Accordingly he can export. And one more very important condition is made: the merchant exporter show procure the goods from the domestic sourcing at concession rate must export the goods within 90 days from the date of the issue of the tax invoice by the domestic supplier. Within 90 days only he has to export. So this is a mandatory requirement. If he is not able to export in 90 days, then the concessional benefit will not be available. The concessional benefit what we are talking about, say 0.1%, is not available if he is not exporting within 90 days. And then who is liable for this the differential of tax? For example, a supplier X, he has supplied to the merchant exporter M. The merchant exporter availed this benefit, means that 0.1% base they have supplied. The domestic supplier sent to the goods to the merchant exporter at 0.1%, and tax invoice is accordingly raised. But from the date of the tax, this tax invoice, the merchant exporter is not able to export within 90 days, then the domestic supplier has to make the payment of the differential amount. For example, the goods attracts the 18%, the goods attracts 18%, but he has made only 0.1% he has made. So the balance of 17.9% has to be paid by the supplier, and along with interest also. So this is the provision, because the compliance is very essential. Here the condition, this concession rate is conditional concession, the concession rate. So the conditions are fulfilled, then only that condition of the concession rate will be applicable. The concession rates will be applicable, otherwise no. So the liability is there in case of the any this it is not been exported, then the liability will be on the supplier of the domestic supplier, because this is not fulfilled the condition. Okay. Then the merchant exporter indicate the GST number of the supplier and tax invoice number in this shipping bill also. The shipping bill, when the merchant exporter is making on his export, then in the shipping bill he has to mention the supporting manufacturer, his name, his GST number, and also the tax invoice number and details. These are mandatorily to be mentioned in the shipping bill, because there's everything is online provisions. These whatever he has made the shipping bill, the declarations, that will be reflecting through the customs portal, then to it interacts with the GST portal. It has to verify GST portal what are the declarations you have made in the GSTR 1 and GSTR 3B, and these are being again verified with the customs portal, and both are matching, then only these will be treated as a merchant export, and accordingly that benefits will be available to you. If it is not matching, then also again that benefit will not be available to you. Okay. After the export, the merchant exporter shall provide a copy of the shipping bill or the bill of export containing the details of the manufacturer's details and other. Means after the export, the merchant exporter, he gets the shipping bill copy. The shipping bill, that copy has to be provided to the domestic supplier, because it is a proof that he has exported. It is the proof that he hasn't exported. So if you not exported, then the liability on the supplier, the domestic supplier, to pay the differential amount of the duty, the tax, that GST. Okay. So this is the condition. Clear? So coming to these provisions, suppose again I will explaining you. The merchant exporter, he must be registered person with GST, and also he must have the RCMC, which is a means a registration cum membership certificate from the EPC concerned. And the merchant exporter, when he is intend to procure the goods from the domestic suppliers, he has to place a purchase order, and a copy of this purchase order has to be sent to the jurisdictional tax officer. Then the registered person, this registered supplier also must be registered with GST. Then only, if non-registered, the supplier will not supply to merchant exporter and can't avail the benefit of the tax. Only the registered supplier. Okay. And then after, the registered suppliers make the supplies, the registered supplier make the supplies to the merchant exporter with the tax invoice and charging the GST at 0.1%. If it is the interstate transaction, that means the supplier and the merchant exporters are in different states, then he has to charge the IGST of 0.1%. If both the supplier and the registered person are in the same state, then 0.05% of the CGST and 0.05% of the SGST shall be charged by the supplier. Okay. Then after the export, means the export has to be made within 90 days. Export has to be made within 90 days. And after the export, a copy of the shipping bill and or the bill of and also proof of EGM. EGM means the Export General Manifesto. This is being filed by the shipping lines with the customs. In the customs portal, the shipping line files the EGM that indicates that the shipping lines, that carrier has taken the goods out of India. That indicates that the shipping line or the carrier taken the goods out of India. So because export means in the goods export, the definition we are talking about, when we are means we are taking the goods from India to outside India is an export, the definition. Therefore, to fulfill whether it is an export or not, that proof must be there. That proof is EGM. That proof is a supply means shipping bill. Shipping bill is a proof that from the customs it is been cleared. The second proof is EGM, that the goods also taken to outside India. So these two conditions fulfilled, then only it's treated as an export. So a proof of export you have to provide to the registered supplier and also jurisdiction tax official. Okay. So then only this will be treated in a merchant export, and this benefit of the making the 0.1% concession duty is applicable. In case he is not made within the 90 days, for example, the merchant exporter not exported within 90 days, then this benefit is not available. Then the supplier is not eligible for the tax exemption if the registered recipient of the recipient means here the merchant exporter failed to export the goods within 90 days from the date of the tax invoice of this. The supplier, when he make the tax invoice, that date is the reference date. From that reference date, 90 days is counted. If is not paid within 90 days, means exported, then this benefit will not be available. Then what will happen? The supplier has to pay the differential GST. Differential GST means already has paid here the 0.1%. 0.1% he has already paid, and the balance amount, for example, this goods means attracts the 18% of the GST, then 17.9% of the balance amount, that the GST amount, has to be paid along with, of course, interest also. So this is how the provision about the merchant exports. Clear it, sir? Clear?
Yes.
Okay, good. Then one more thing I will tell you. Whenever the merchant exporters making the export, sometime back we have studied export under GST. Then I told you there are two options are there for the exporter. There are two options are there for the exporter. One is without making the without paying the GST under LUT, means he can export under LUT, letter of undertaking, without paying the. Hello, please mute, sir. Please mute. So resounding is coming. Please mute. Sir, from your side, please mute. Otherwise, resound will come. Yeah. Thanks a lot. So when he is in exporting, there are two options as I told you. One is the without payment of the GST under LUT, letter of undertaking, and when he is making the letter of undertaking exporting, then he need not pay the GST. The other option is he can make the IGST on payment of the IGST, and then he can take the refund of the IGST. That is the second option. The two options are available for general in for any exporter. But when you are availing the merchant export benefit and as a merchant exporter, then the second option is not available to you. The second option is not available to you. As a merchant exporter, you have to only make under the LUT only, and what are the duties you have been tax you have paid, if any available, that you can get the refund of the ITC. So the second option of exporting on payment of IGST is not available. Very clearly, it is very clear in the statement, right? Then the second, the supplier of the domestic market supplier making the means supplies to the merchant exporter at say 0.1%, then what will happen for him, the ITC, because he has taken ITC. Example I will tell you. Just a minute. I'm just showing you. He is a supplier. He is a supplier, for example. Okay. Then he is sending to the merchant exporter. Merchant exporter. He is making the certain supplies. Just a minute, sir. He is making the certain supplies. Okay, he is making certain supplies. He is making the supplies. Please mute your yes, sir, background noise is coming. Please mute. Everybody requested to mute. Hello, please mute. The tax invoice he is making. The supplier is making the tax invoice, and the GST he is charging at 0.1%. Okay, 0.1% charging. But suppose he is getting the inputs what he is getting, the supplier, for his own manufacturing. The inputs what he is getting, for example, some raw materials, packing materials, whatever may be, he is getting the inputs, and there he is paying, for example, GST paid is, for example, at the rate of say 18%, and of course he is entitled to take the ITC taken, but he is paying now only 0.1%. Then what you will do with the accumulated this ITC? The ITC getting accumulated because he is making the payment of say only 1.1%. Example I will tell you. Suppose the transaction is say 100 rupees. The transaction here, the transaction is say it is 100 rupees. Sorry, 150 rupees. The value is say 150, on which he is paying the payment of say 0.1% only. Means GST at 0.1%, it comes to 1.5%. 1.5 only it is coming. Okay, 1.5 and sorry 0.15, no, sorry, now 0.15 he is paying. But when he is getting say input, that ITC what he has taken, for example, that value, the value is for example is say 100, and ITC now he has taken is rupees 18. He has taken ITC rupees 18, but only paying the 0.115%, 15 only. But what will happen with this difference? This is accumulated. So the supplier is now allowed to take the ITC refund also. Means that this is under the inverted tax, not under normal provisions, but inverted tax it's called. Inverted tax means in GST, you must have heard, in GST there's inverted tax provision is there. That means the tax payment is on inputs is higher than tax payment on the finished goods. So here also it comes to the similar way. The tax paid on the output is less, but tax taken, input tax credit taken is higher. Means the tax paid on the inputs are more, but tax paid on the output is less. So it is comes under the inverted tax provisions. So therefore, the supplier can make the refund claim of the inverted tax, the differential of the amount, inverted under the inverted tax provisions under the GST. Okay, so that is what this case we are talking about. The merchant exporter can claim the whatever he has paid the tax. The tax he has paid is say it is only 0.15% here, for example. Means under the rate of 0.1% is paying. Whatever he has paid, he is entitled to take the input tax credit, the merchant exporter, provided he has made the exports within 90 days. The supplier also can make that what are the differential that amount of the tax as per the inverted tax provisions, the differential he can claim as a refund. Okay, so this is the provision about the both can claim. And again, one more condition we had to tell. Suppose the export is not happen, as I told you, the supplier has to make the differential rate of the duty has to pay it. And here in this notification it is very clearly mentioned, the registered recipient merchant exporter may, if required, exclude the commercial invoices. This he had told, we are told, means that the shipping bill has to be given to the supplier. When the shipping bill is provided to the supplier, there the original means export that buyer's details are being exposed. The buyer's detail means that who has been importer of this goods, overseas buyer, that details are been exposed. Then the merchant exporter's credibility or his secrets and other things also will be exposed to the supplier. So therefore the representation are made. Then through this notification it is been made clear that whenever this merchant exporter is giving a copy of the shipping bill to the supplier, he can keep certain provisions, very important critical, he can exclude from that shipping bill. For example, shipping bill printing you have taken, you can make a whitener or you can erase certain important information like the buyer's contact details or other values and other thing. You can eliminate also, no issue. So that is what the provision. Okay. And this merchant export provision is not a mandatory, it is an optional. As a merchant exporter, if you want to get the material from the supplier on full payment of the GST, and then you can export and claim the refunds and all thing, then you are at liberty. Then you have both the options. You can export under the without payment of tax under the LUT, or you can export on payment of IGST and claim the refund. Both the options are available, provided you are not taken the concession concession tax GST. But if you take in the concession GST, then only one option is there: the merchant exporter has sent the goods on LUT only. So I believe it is now clear. Now let us go to the high seas transaction. In the high seas transaction, what is the high seas? Sometime back I expressed to you, I told you, but the high seas later the provisions are little bit changed after the GST has been introduced. High seas generally been treated. High seas is been treated when it is a means from the land place, land border. This is, for example, land border. From this, after the 200 kilometers, 200 nautical miles above it is called as a high sea. 200 nautical miles above the beyond the border line is called a high sea. Beyond the border line of 200 nautical miles, beyond it is called high sea. When earlier in this before the GST, high seas transactions are being made to avoid CST. CST means central sale tax. That was applicable that time 2%. To avoid this 2%, people are using the high seas transactions, because when they bring to the India and then they supply to somebody, some other person, then the tax used to be applicable. To avoid this tax, CST anyhow there is no provision to get the any of the credit. CST credit is not available. If it is VAT, of course no issue, you can get the VAT credit, but CST there was no provision for getting any credit, so that becomes a cost. So 2% cost for any of the transactions, business transaction, is a heavy amount. Certain times people are getting hardly that marginal profit of say 3% or 4%. So 2% state they are incurring as a cost, then that is not viable. So therefore these merchant means the merchant traders and all thing, what they used to do is they make the sales on the high sea. Means before it is arriving the 200 nautical miles, before it is arriving the means import consignment I'm talking, import consignment, before it is arriving the 200 nautical miles, if you make any of the transaction, you can sell to anybody else. In such case, no CST or any other tax, Indian taxes are not applicable. No tax is applicable. So therefore the transaction can be done on high sea. But after the GST has been introduced, the high sea concept is little bit changed, or entirely it is been changed. So what are the provisions? Let us understand under the GST and then customs provisions, right? The high seas transaction, now that made it, any transaction taking place before filing of the bill of entry are termed as high sea sale. Now high sea sale, they made this one before filing of the bill of entry. This transaction is called as a high seas sales transaction. Okay. Earlier meaning is different. Earlier is before 200 nautical miles. Before it is reaching the 200 nautical miles, if you make the transaction, that is called high seas transactions. But now with the GST comes into, this provision has changed, and this talks about like this: before filing of the bill of entry only we are taking as a high seas transaction under the common parlance and all things. And of course there is a section 7.2 of the IGST, and here they're talking about initial provision was there. The supply of goods imported into Indian territory of into the territory of India till they cross the customs frontier of India shall be treated to be supply of the goods in the course of interstate trade or commerce. This provision made certain confusion. This provision made certain confusion. Therefore, the high seas transaction also comes under the tax provision. IGST supposed to be paid because it is treated as a interstate transaction. But later through circular, they made this clarification that IGST on HSS means high seas sales of imported goods, whether one or multiple, shall be levied and collected only at one time of the importation, not multiple times. There is no need for making the payment. Earlier what happened before this one, the circular, there was confusion, so that tax authorities are demanding whenever there is a high seas transaction. So for each of the high seas transaction, maybe there are n number of high seas transaction can happen. Say the original importer imported, then he may sell to say Mr. X, and the X may sell to Mr. Y may sell to Mr. Z. Like that, many transactions can happen. Generally in the trade it used to happen. So in such case, for each of the transaction, the these GST officials are demanding IGST to pay it, because this treated as an interstate transaction. So they are interpreting that way to collect the tax. But later after this circular, it was become very clear, only one time has to be paid the tax, no other taxes has to be paid. So means at the time of importation, the final buyer only has to make the payment of the customs duty, where in the customs duty the IGST is a part of that customs duty. As a part of the customs provision only has to pay the IGST, but not multiple times. So very clearly they made through this notification. Here this CA talks about this duty will be levied and collected only at the time of importation, that is when the import declarations are filed before the customs authorities for the customs clearance purpose for the first time. This made very clear. Only when they made the this is customs circular. There's earlier is a GST circular, this is the GST, and this is customs circular. This custom circular very clearly talks about these provisions. Only one time has to be paid when the bill of entry is filed. But multiple times when the transactions happen, there is no bill of entry has been filed, so there is no need for any payment of the taxes or duties. Okay. Then what is the transaction value? The transaction value is, suppose means the original importer, he purchased for example at 100, he sold to somebody Mr. X he has sold at 120. X has sold to somebody else at 150, for example, and the Y has sold to Z at say 200. Now what is the value at which that means customs duty has to be paid? So the assessment value is the last buyer who is making the payment, I mean, who is filing the bill of entry, and that value is taken as a value, not the original value. Original value is maybe 100, but later it's been sold at the last sale happened at 200. So that 200, on that the duties has to be paid. Okay, that means, okay, I will show you how it is happens. Though you have made n number of transactions before filing of the customs bill of entry, those are being treated as a high seas transactions as per the new provisions. Suppose this person is the original original importer, original importer. Then this person is a buyer, buyer say X. Then another buyer may be buyer Y. The other buyer may be Z. Okay. There is an original importer, and original importer is sold the item to the X, and X is sold to Y, and Y is sold to Z. For example, like this. So the original value, for example, this one, original value, for example, it is say 100. Original value is 100. And he sold this 100 item to the first the buyer. This is called high C sale. High C sale for the value, say it is 120. High C sale is 120. Then other the the buyer X now is sold to another person, Mr. Y. Mr. Y he has sold. So this is say example, say 150. And again the Mr. Y has sold to Mr. Z, say it is 200. 200, sorry, is a 200. Now the bill of entry, now he's been made, the bill of entry is made by Mr. Z. Here the provision we are talking, it is a this line we are talking about the bill of entry, filing of the bill of entry. Who files, that is the matters. This is filing bill of entry. Filing of bill of entry. This filing of bill of entry is done by Mr. say here Mr. Z. Files bill of entry. Files bill of entry. Now who is now importer? Actually the importer becomes the Z, becomes the importer. Z becomes now the importer. He has to make the payment of the duty. He has to make the payment of the duty. At what value? The value now will be, because the value he has taken as 200, assessable value for customs duty is 200. 200. On 200 now he has to pay who? The this buyer. And up to this line we are talking about, this side is called high seas transaction. All these things whatever happened are called as a high seas transactions. these all n number of transactions happen. These are all called high seas transactions. This is the new provision. Earlier high seas mean that 200 nautical miles were there, but now it is not so. High seas transaction. Okay, all these things. Before it has been filing the bill of entry, all these things are treated as high seas transactions. There can be a number of such transactions can happen, but the value is what is made at the last, the buyer, the final buyer, what he has to pay or intended to pay. That amount, that value is taken as for the assessment of the customs duty. And now for the customs purpose, for the clearance of when we are making the filing of the bill of entry, you has to provide the original invoice and all these transaction details you had to mention to the customs authorities, because to arrive at the final transaction, all the previous transaction details must be provided. Means what is the original value and what is that A, and this transaction final, all these things has to be provided, so that customs will satisfy that yes, there are n number of transactions happened on this means goods transaction, right? So this is how
Sir,
the,
this
yes sir.
finally jet buyer has come to know what is the original value of the goods.
Yes sir, it is essential required, no sir. All the
It is
invoices
a
has to be
business
sent.
confidential, right? The price declaration.
Business confidential, but essentially that is also has to be declared. Otherwise what happen is how the customs official can determine what is the value and other things. That
What is the
value,
value? Yes, 200 is there, right? He has
that
last
200
transaction
there,
value is 200 is there.
200
That is
there,
the value for.
yeah, 200 is there, no doubt. But these transaction happen between these all the people must be declared with the customs. That
Okay.
is an essential condition. If you see the all these things, you see there is an essential condition that these must be declared. The company of
Okay.
Germany
And
has a
that
transaction
one
also. Yeah,
here it is
yeah,
uh,
yeah.
uh, X Y transaction is the original importer X Y. There is no
Hmm.
IGST, right? For this
Yeah, no,
transactions.
no, no transit. That is
The,
what I'm again coming. I'm coming
hmm,
just one by one. I'm coming. This is from the customs point of view. I told you.
hmm.
Now I'm coming from the GST point of view. GST point of view. For example, there is n number of transactions happen. These are all treated as a supply. These are all treated as a supply. Then there is a provision is there. Just a minute. I will give you what is that provision. Yeah, this one. This provision they made for the high seas transactions under Schedule 3. Under Schedule 3 is neither goods neither services. The Schedule 3 talks about, you must have knowing the Schedule 3 under the Section 7.
Hmm. Yes.
Schedule 3 under Section 7 of the GST, CGST or IGST, if you take, then it will be very clearly written what is not a supply. Means neither it is a supply of goods, neither it is supply of services. So those transactions are there. There it is been included the merchant trading. You see, this is merchant trading. The supply of goods from a place in the non-taxable territory to another place in the non-taxable territory. This is also, it means this is for the merchant export. And this is, sorry, this merchandise export. That is from the other country to other country. For example, you are a supplier, you got an order from the US, you have made a supply from the China directly to the US. In such case, that transaction will not come under the GST provision. Okay, because it's non-territory, non-taxable territory to another non-taxable territory, so it is not covered. Then the other also
But
they provided the
but
high
last
seas.
time, sir,
High
last
seas.
time we had a discussion. But in
Yes,
this case, last time in the place of supply, the rule,
uh,
section 11,
uh,
12, 13 of IGST Act.
uh, that is a place of supply. We are talking about the services. I told you, sir. Services, I told you there are 5 conditions has to be satisfied, and place of supply has to be satisfied as per the section 11, 12 and
12,
13.
13.
12, no, service is 12 and 13, goods is about 11.
Hmm.
section 11 of the IGST, if you see, there are three provisions are there for this place of supply. Through one is about the goods, that is 11. The other one is 12 and 13. So accordingly, I have discussed that time about the services. And the goods, one thing I told you, when it is not originating or moving from India to outside India, it is not an export. When you are making from a supply from China to US, in such case, from non-taxable territory to another non-taxable territory, therefore there is no GST, because that is what they mentioned in the Schedule 3. And this provision comes into effect from the 1st of February 2019. Before that, there is a lot of confusions. Before treatment, you leave it. After that, when they made a clear notification and they incorporated this provision, from that time, this is applicable. Otherwise, these high seas also, there was confusion. People are paying also. And there are certain advanced rulings also. Contrary advanced rulings are there. Here, coming to the high seas, our point is coming to the high seas. The sale carried out by the actual consignee, that is the original importer, shown in the bill of lading to another buyer by endorsement of the documents of title to the goods while the goods are yet on high seas, or after the dispatch from the port of loading and before entering the customs frontier, and then filing the bill of entry. So according to this provision, as per the Schedule 3, now what happens is, here I am coming, because till this all these transactions are called high seas. During the high seas, they call it is neither goods neither services. When it is neither goods and neither services, then GST is not applicable. GST provision is very clear. The GST is applicable on either goods or the services or both. It is very clearly defined in the section 7, the supply provision. So if it is not a goods or it is not a service or not both, then no tax will be applicable. So therefore, when this is under Schedule 3, neither goods neither service provision, therefore what are the transaction happens between the original importer and the buyer X, and then buyer Y, and then of course buyer Z, these things up to these transactions will not be subject to any GST. Clear, sir? Clear, or any doubt?
Clear, sir. Thank you.
Okay. Just a minute, I mentioned also. These all transactions Schedule 3. No GST. Very clear. That is where no GST. They deliberately kept on this Schedule 3. Before that, of course, there is a confusions are there that they're not made is a, but
Sir,
before that, lot of, let me complete, sir. Before that, lot of confusion were there. Lot of people also paid. But when they made this provision of including this transaction under the Schedule 3, Then they made the schedule 3, what are the inclusions are made, these are retrospective, means what are the cases pending, those can be cleared. But those who are already paid, then there is no, of course, recourse. That is a provision. Okay, sir. Tell me, sir. You are telling something.
Sir, FTWZ sales,
Hmm.
where it is comes under GST?
That is warehouse, no, sir. That is a warehouse.
Ah, warehouse,
Warehouse,
but
warehouse
where we need to
provisions.
disclose it in the is it required to disclose under GST any returns GSTR 13B?
GST filings you are talking about.
Yeah, disclosure is required. FTWZ sales, whatever the sales made because of
Sales. No, listen,
yeah,
sir. You're talking from the FTZ or something from that warehouse to the domestic DTA, or from the DTA to that warehouse. What you're talking about?
warehouse to DTA, sir.
Warehouse to DT. Okay.
Ah,
Warehouse to also they are like warehouse like SCZ. All these things are one same provisions. Either SCZ or this type of trading warehouse. These are trading warehouses. Okay.
okay.
And these also has a similar provisions. What are the SCZ declaration has to be made. Here also same declaration has to be made. The declaration must be made in this 6B, I believe, in the GSTR 1 provision, table 6B.
Sir, table B, where I am
Mm,
importing, suppose I am
mm,
importing under FTWZ, without
mm,
receiving him, my customer has filed the bill of entry and cleared the goods he has taken from warehouse to directly his premises.
mm.
That
Mm.
transaction not at all comes under my books.
No, that is
All,
that will
uh,
very good, very good. That question is either SCZ or FTWZ. Both
uh,
are similar provisions. In such case, it is import for the DTA. The
uh,
DTA has to make a declaration as per the import, not as a
uh,
export of the export from the means supply from the this SCZ. Like
hmm,
the treatment is because these are like foreign territory. These are
hmm,
like foreign territory, so that the DTA who bought the material, he has to make the bill of entry. That bill of entry, once they made that, he has to make the declaration, and he can take the ITC and other things, all the provisions as if it is an import. So,
okay.
so therefore, there is no duplication of the requirement by the SCZ to file the some transaction details. No, because it is
Oh,
import for the DTA. So the DTA
but,
person. So
sir.
general, sir, even in the normal import also, what you are doing, that bill of entry has to filed by the importer,
Hmm.
and what are the import transaction happen, based on that he has to take the credit and all those things are allowed. Similarly, when you are bringing certain material, buying from certain material from the SCZ or FTWZ, then this is also treated as import for the DTA. The DTA has to make the all the filing of the transaction, whatever the requirement, he has to file as an importer only. But the SCZ will not make the transaction. If we make this, duplication happens, no, sir. So therefore, it is avoided. SCZ or FTWZ will not make any declaration for this.
But there is a transaction value for that.
Mm,
What I
mm,
imported, what I
mm,
selling to end
mm,
customer, there is
mm.
a value is difference is there.
Yes, 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 sir. Value difference is maintained, sir.
How to is it required to pay GST on value difference or not?
So the FTWZ has imported certain goods, say 100,
Hmm. Hmm.
and he sold for example 150.
Yes, sir.
Okay, when he is selling the 150, on 150, the customs duty is applicable for the DTA. Customs duty has to make the payment,
Okay. Under 150 or
and
100 rupees, sir.
150, na sir, he has made for the
Okay.
150 the import. So the on 150 only he has to make the payment. So 150 has to make on 150 only, assessable value become 150. On that, customs duty has to be paid. IGST is part of the customs duty. He is not paying a
Yes.
GST part as a part of the customs only, he is making the
Hmm.
payment of the customs duty, IGST. So that is how it happened. But when the transactions between or within the FTWZ, those are like foreign country transactions. Therefore, these are not applicable any taxes.
Okay. Thank you, sir. Thank you.
Thank you, sir. Thank you. So I'm sure that you have a clarity on this high seas transaction. Like all these thing, n number of transactions happens also. There is no GST. That is very clearly made on the Schedule 3. But before that, of course, there is a confusion, as I told you, and most of the people paid also. Some of my clients also paid because there is harassment, so they paid. But later, when they made Schedule 3 provision incorporating these transactions, then they made it retrospective. It's not as a prospective, but retrospective, they told. So previous cases can be settled accordingly. So that settlement was done. Okay. Then inbound sale also, you see, inbound sale also they kept into this. Inbound sales means within FTWZ, you are making, there also various suppliers are here may be there. Not it is one, maybe n number of suppliers may be there. And if you are making any transaction within that FTWZ, that also there is no tax because it is treated as within the foreign country actually. So Schedule 3 they provided very clearly. So therefore there is no tax on that. So now comes to the deemed export provisions. Deemed exports. Deemed exports, as I told you, there are three conditions are there to satisfy the deemed exports as per the this FTP, foreign trade policy. Foreign trade policy talks about deemed export transaction in which the goods supplied do not leave the country. That is the first condition. The goods supplied do not leave the country, India. The second is payment for such supplies is received either in Indian currency or foreign free foreign currency exchange. So the third is goods must be manufactured in India. The goods must be manufactured provided the goods are manufactured in India. Here very clearly they told manufactured in India. Goods are manufactured in India. Then only it is been treated as a deemed export. Suppose you are importing certain items from China and supplying to EOU, claiming that it is in a deemed export. No. So in this provision they made very clear under this foreign trade policy, provided the goods are manufactured in India. So these three conditions has to satisfy, then only these are treated as a deemed export. Okay. And deemed export as per the foreign trade policy and as per the GST, lot of difference is there. In foreign trade policy, deemed exports also includes, for example, you are bidding against a foreign tendering, you have bidded and you won the contract, and you then procuring from the domestic supplier some items. Those items in the domestic supplies you are taking for the purpose of the international bidding contract. That transaction also treated as a deemed export from the foreign trade point of view. Foreign trade policy point of view, it is also treated as a deemed export. But in GST, they very clearly mentioned what are the deemed export. Only there are the three or four conditions are there. Only those transactions are only treated, but other transactions are not treated as a deemed export. Okay, means what are those conditions? I'll tell you. This is the notification from the means this yeah, GST point of view. Following supply of goods are treated as deemed export. One is supply of goods by a registered person against advance authorization. When now the deemed exports was made, the supplier must be a registered person. Very clear. That is also mentioned. The registered person who supplies against the advance authorization, then that transaction is treated as a deemed export. The second one is supply of the capital goods by a registered person. Again, they mentioned the registered person. Only registered person only eligible for it. Okay, to a EPCG license holder, then this is a treated as a deemed export. The third one is supply of goods by a registered person. Again, you see repeatedly they mentioned registered person to a EOU or EOU family. The EOU family means electronic hardware, means technology park, or service export promotion councils or parks are there. Sorry, not promotion parks, that parks, service export technology parks, are the biotechnology parks. All this in comes under the a family like EOU family. One same chapter, same benefits. Okay, under the chapter 7 of the foreign trade policy. Okay, if you are supplying to them, then it is treated as a deemed export. Then the fourth one, public sectors. If you means a supply of the goods by the bank or the public sector, these are for the jewelry, only for the jewelry sector this is applicable. Suppose the jewelers, they can't import the gold at the high, means very frequently from the overseas imports. Many times it is not possible. So what they generally do is there's a pooling centers are there. Banks, public sectors form like a pooling center. They import in a heavy quantities. Then the local supply, means local exporters who are there, who are maybe taking the advance authorizations, for them these people will supply, because there are small jewelers, they themselves importing and other things may not be possible. At certain times it's difficult for them, so the government provided this provision so they can do it. So these are the four transactions are eligible for the deemed export provisions. Only these are defined as a deemed export as per the GST provisions. Okay, but foreign trade policy provisions, there are n number of other transactions also treated as a deemed export. Suppose I will say take into the foreign trade policy, then let us see what are all those are covered under the deemed exports. You can take the DGFT, sorry, DGFT, then the regulatory, this one, then the foreign trade policy. In the foreign trade policy, the seventh chapter we are going to go through it. Then it will be, sorry, seventh chapter, the deemed exports. So this is how we download. And the deemed exports means what? Basically, what are the deemed exports we talked about? Then what are all the deemed exports? Just I will say, you see, these are all called as a deemed export supplies, supplied by main or subcontractors of the what are the we have made international bidding or foreign trade, means this Department of Electronic Affairs or Ministry of Finance. Like this, all the transactions are treated as a deemed export. Also, if you are supplying the goods to a nuclear power plants, then also it is treated as a deemed export. Also, suppose you are supplying to, sorry, it is also if you are supplying to any of the thermal power plants, super thermal power plants they called it, those also treated as a deemed export. Just again, yeah, just again. Supplies to United Nations, international organizations, these also treated as a deemed exports. Supply of the goods required for setting up of the mega power plants, this ones here, mega power plants, if you are supplying to them, these also treated as a deemed exports. Like this, lot of other transactions are there treated as a deemed exports. Okay, but As per the GST, only these four transactions are treated as deemed exports. So that is the difference between both the provisions. And what are these means refunds and all thing available for only these four conditions satisfies, then GST refund will be available. GST refund for only these four conditions. Others are you have to claim the remissions under the foreign trade policy. So you have to file to the DGFT, but not through GST provisions. Okay. So when such GST provision, the refunds included already, I told you refunds also allowed, but first you have to make the payment of the tax, then claim the refund. The input and input services, however, export of the goods on payment of IGST is not. This how it happens. I'll tell you how the transaction goes. There is a registered domestic supplier. The domestic supplier must be registered, as I clearly told you. Then only this transaction will be treated as a deemed export. He can make to the four of the transactions. Any of these, if you supply, the domestic registered supplier supplies to advance authorization holder, or the EPCG authorization holder, or EOU, EHTP, or STP, or BTP units, or through bank channels. I told you for the gold, the bankers are selling the gold to the advance authorization holders of the jewelers. So that is also treated as a deemed export. So these transactions are treated as a deemed export. And in the deemed export, when he is making the transaction, it is not treated as a zero rated supply. The deemed export transaction is not treated as a zero rated supply. Therefore, LUT provisions are not applicable. And he has to make the payment of the GST first, then he has to make the claim of the refund. Refund claim provision only made, but no exemption allowed. Exemption is different from the refund. Exemption means on the face of it, you need not pay anything. But here, first you have to pay, then get the refund. Now, the deemed export, the refund, either the domestic supplier, this person can claim, or any of these persons can claim. Either of them, not both. When that claim is there, then you have to make a disclosure. When they make a disclaimer provision, disclaimer means suppose the domestic supplier is getting the refund, he is making the application for the refund application is on RFT 01. There he has to make a application. In the application when he is making, then he has to take the disclaimer certificate from the recipient. The recipient has to give that they are not claiming any such refunds. Then only the domestic supplier can get the refund. On the other hand, if the recipient wants to get the refund, then the domestic supplier has to give the disclaimer. So on the disclaimer only, that transaction means a refund transaction will be processed. Clear, sir? Deemed export provisions. Any doubt? Then evidence also has to be provided. The acknowledgement by the jurisdiction tax official authorization. The evidence must be provided. If they claim the refund, there must be evidence that these are being received by the recipient. Because when the domestic supplier make the supplies, and there must be certain evidence that these are being received, undertaking by the recipient of the goods, that no input tax credit is availed by him, that is disclaimer. The disclaimer has to be provided, and an undertaking by the recipient of the goods that he shall not claim the refunds. So input tax credit also not allowed. No input tax credit is allowed on the transaction, and also no refund is allowed. Then only the refund is processed. Clear, sir? Suppose again I am going back. Suppose here he made the GST payment, IGST or CGST or SGST, and the recipient should not avail the ITC. When the refund is claimed, then this person should not claim the any ITC, otherwise it will be duplicate. And only 1% is allowed to take the refund, either the supplier or the recipient. Okay. And one more important concept behind deemed export is the deemed export. The deemed exporter means, for example, again I will show this one. Here, suppose these things are conditions are fulfilled, refund and nothing. These persons, these recipients has to export the goods only under LUT. They are not allowed to make any exports under on IGST payment. Only under LUT only has to make the payment. These persons, they make the direct export. These exports must be made under LUT only. That is very clear. No exports allowed on payment of IGST. Means IGST provisions are not allowed. Payment of IGST, then claiming of the IGST refund is not allowed. Only on LUT only they has to make the payment. Okay. So this is about the deemed exports. Now let us come to the this merchandise export. Generally we call it a third country, but it is a official, the correct official name is about merchandise exports. Okay. The merchandise exports, for example, one transaction I tell you. Indian business, he got from the US customer an order he has received, then he has sourced this from the China, and Chinese supplier made the supplies directly to the US customer, and therefore the order is fulfilled. Then payment is received, say in US currency, in US dollars he has received. So whether this is a export or not, that is what under GST provisions we want to understand, because the goods are being exported maybe from other country, also the payment also received in foreign currency. So whether this is a export or not, these are called as a third country, or it is also called merchandise export. Whether this merchandise export is a really export under GST or not. Yes, sir. He received the payment in foreign exchange, foreign currency.
No, sir. Since goods are not taken out of India.
Hmm. Goods are not taken out of India, therefore these are not treated as a export, because the export to the goods condition is there, that export of goods means as per the GST, that provision is given very clearly in the section, say it is 2.5, it has been definition section. So in the defined in this section, export of goods is defined as taking the goods out of India from to a place outside India, then only it is treated. But in this case, it happened from the China to the US, but not within India to US. It is not reached the India then exported, so therefore it is not treated as a export, not considered as an export. That is very clear, right? Then whether the transaction is treated as a supply and GST is applicable on the third country export or not. So that is means you are a Indian businessman and you got from the customer and they received the export order, and these have been fulfilled. Goods have been shipped directly from the third country, and the invoice is raised by you as a Indian business person to the US customer, whether here the GST is applicable or not. You have received the payment, but the GST is applicable or not is the question.
No, sir. Schedule 3.
Hmm?
Schedule 3, that the supply of goods from non-taxable territory to another non-taxable territory.
Okay, that transaction is from China to US. China to US, that is there. But you as an Indian businessman raising the invoice to the customer, US customer, that invoice whether taxable or not we are talking about. Okay, from China to whatever this material is going to US, that transaction is non-taxable territory to another non-taxable territory. So, okay, here also again, because it is not GST applicable on this transaction, this is only commercial transaction happened, but no goods means exported or moved from India to US. So it is only the commercial transaction happened, but not the through treated as a export. No GST is applicable. So here the no GST you can, and on the invoice you should not raise any of the GST. Of course, you have to raise the commercial invoice, not the tax invoice. That is the meaning of it. Commercial invoice you have to raise without charging any GST. Okay. Of course, this provision, what they made the entry is effective from the 1st February 2019. Very clearly that effective date. But before that, of course, question mark. Okay. Then the customer, non-taxable territory, the supplier also non-taxable territory, directly the goods are moved. So between them, there is no tax. And India, you are receiving the without goods entering into India and moving out of India without reaching to India. So this is the transaction happened. Okay, not treated as a supply under GST. This is entry number 7. Whether the third country exports are treated as an export under GST, as already we have discussed, these questions, these are the 3 questions are there. That is the answer. The first one is, since in the case of the third country export, goods are not physically moved from India, therefore it is not treated as an export. Okay. Then whether third country export treated as supply and applicable to GST, again it is not treated because non-taxable territory to non-taxable territory, that movements happens. Therefore, there is no GST is applicable for the transaction. Only commercial invoice you have to make, not a taxable invoice. But as I told you, there are different views are there. Two different, these authorities made the two different type of judgments, means there yeah, but this is a contrary happened. But after the inclusion from the 1st of February 2019 on the schedule 3, then the matters are settled. But otherwise earlier lot of these type of disputes are there. Different authorities are made different of the opinions. Yeah. Okay, this is are the case studies actually. The different authorities made different opinions, so it is a raised certain doubts. Then the board has clarified, CBIC board has clarified, and they brought this into schedule 3. Then the matter is settled. Now we are coming to the sending the samples out of India. So before that, can we take a small 10 minutes break? Then we can start. So let us take a 10 minutes break. Then we can start with the sending the samples out of India, and other provisions are there, import and re-export. Those provisions are there that I will discuss.
Sir, one point. Sir,
Yes, sir. Sir,
yeah,
tell me.
X located in foreigner is located in US,
Mm-hmm.
and he's AG is a company. He is subsidiary of. He has one investment is 1,000 crores invested in India as a
Mm-hmm.
established one company under Companies Act and doing business. You
Mm-hmm.
know, but director are both are same. Both companies are director are same.
Okay.
He got the
Okay.
order from parent company in other companies also same country. He is
Yeah.
exporting from software from India to foreign country.
Okay.
His all obligation has fulfilled. Five,
Uh,
whatever it is there, five is there. Five is fulfilled except five. Four is fulfilled except five. That
uh,
is director
mm.
interest of the both company director are same.
That is related party you're talking about.
Yes, yes, yes. Related
Yeah.
party. Is
Okay.
it qualified for export of service?
Yes, sir. Yes, sir. That is why at that time, when I'm talking about export of service, I
Hmm.
told very clearly when there is, it's not like talking about the related person, but they're talking about suppose you are in India and the
Hmm.
your other company of the same companies, another license office is there in foreign country,
Hmm.
but that foreign country was not registered in any of the foreign country provisions, then that for fifth condition what you are talking is applicable.
Okay.
But here we are talking about suppose TCS is there in India,
Ah,
and TCS another office is there in for example UK,
yes.
and in UK it has been registered. TCS is
Yes.
registered in UK, and TCS office is there in India, they are registered. Suppose
Okay.
from India to it is exporting to UK, then
Hmm.
this is treated as an export of service.
But
That,
TCS
that
India and export UK director are both are same. Both companies director are same.
let So let it be, sir. That is a related person, not to confuse here.
Hmm.
Related person is comes for the valuation purpose.
Okay.
Valuation purpose is the related persons. But otherwise,
Okay.
these are the two different entities.
Okay.
Practically, from the what of the acts and all thing in the foreign country, they are registered. And
Okay.
Indian country, you are registered. Both are
Okay.
registered, are both are different entities. So
Okay.
therefore, this is treated as a service export. And of course the valuation purpose only you can refer to the related party transactions.
Oh, okay.
Okay, sir.
Okay. Okay. Thank
Yes,
you,
sir.
sir.
Now,
Thank you so much. Thank you so
okay,
much.
thank you. Now we are going to understand about the sending the samples outside India. Okay. First we have to see what are the important export. The first provisions we have to see into the foreign trade policy. In the foreign trade policy, whether it is allowed or not, what are the restrictions we have to understand. The second, from the customs notifications we have to find out, or first customs provisions. What are the provisions for the customs? Because the goods are moving through customs stations only. So the customs has to clear it. So the customs provisions you have to understand. Then there is another one is the third agency, that is RBI. Because whenever you are sending any of the goods outside India, then corresponding to that goods value, you should realize the amount has to be realized through a banking channel. That is a mandatory requirement from the RBI. So whenever you are sending the goods free of cost, then what is the means transaction? No transaction you will receive, means you will not receive any consideration, because these are samples are free of cost. So therefore, whether the RBI provide any provisions for making these waivers and etc. So RBI provisions you have to read. So these are three aspects we have to look into broadly. One is for the foreign trade policy point of view. The second is from the customs point of view, because customs practically clearing the goods. Then the third one is transactions related, that is for the foreign currency transactions. So therefore, you have to refer to the RBI provisions. Okay. So these are the broadly three provisions that to look into. Okay. So what are these provisions? Just let us see. Whenever you are sending the samples on the invoice, you have to mention very clearly, sample not for sale, no commercial value involved. These writings are standard. That is very essential. Also on the sample boxes also you have to write down these markings, that sample not for sale, no commercial value. So the declaration also accordingly has to give in the shipping bill about the transaction. Customs, when you are filing the shipping bill, because it just goes to shipping bill, then in the shipping bill you have to make the transaction this also, not for sale, means sample not for sale, and no commercial value. This declaration has to be made in the shipping bill. Okay. And there are certain provisions are there which restrict the value, up to what value it has been allowed. Time to time, of course, these have been changing. So what is the latest provisions we have to refer? What is the latest provision up to which the GR waivers and other things are allowed? GR waiver means that is for the declaration we have to make to the customs. But now that GR waiver is merged into shipping bill itself, at the time of shipping bill filing, the GR waiver also a part of it. So you are declaring. So separate GR waiver, GR form you need not file. So this is because of the automation they made now, means e-filing. In the e-filing, all these additional filings have been removed. The GR generally form we used to file for the for the RBI purpose, because from the transaction purpose, whether we are has to receive, we are making the declaration that whatever we have declared the value we are getting the amount through the banking channels. So that is what the declaration you are making. But the declaration now online declaration. But now we have to see what are the provisions talks about these notifications. This particular notification is there. This notification here they're talking about certain exemptions allowed when you are sending the goods for samples. In the samples there is no realization, means there is no consideration you are getting from where you are sending to the overseas customers, for example. Then you're not getting any consideration for it, because these are free of cost samples. So say certain exemptions are there for the from through waiver of the GR. So what is the exemption? Let us understand. These exemptions include export of goods valued not more than 25,000 and export of gifts not more than 5 lakhs. Up to this, there is a certain exemption is allowed as per the RBI. This form has to be in the form that the GR waiver form, this is called. Means up to this, you are not getting any realization. So therefore, the bankers or the RBI will not ask you for the payment, means whether you are received or not. So what is this notification talks about? Let us see. Mm. This is what they're talking about. Interrelated, this is a notification that circular is there, RBI circular. In the RBI circular, this is about the foreign exchange management, FEMA regulations, under which the annexure is there. Here you see the waiver GR we are declaring that declaration as regard to export of goods and services. In this declaration, there is certain exemption is given. That exemption we have to see. Just a minute. What is an exemption? These declarations you have to make, as I told you, that you have to get realization. This is an exemption. These exemptions are provided. Here you have to see what are the exemptions. The exemptions are there. The trade samples of goods and publicity material supplied free of payment. So then this GR waiver condition is applicable. The exemption. This is what is the exemption we are talking about. Then personal effects of travelers. Travelers also they are bringing certain things. Then that is also comes under the accompanied. You see whether accompanied or unaccompanied means on the baggage. Then ship storage also allowed, given that one. And here the goods or software accompanied by the declaration by the exporter that they are not they are no more than this 25,000 is it up to 25,000 USD value. Up to this the waiver is applicable. You can apply for the waiver. Then means in the shipping bill itself you have to make the waiver condition, and accordingly you can export the samples. And other conditions are also where this exemption is available. It is given here by way of gift of the goods, and in that case it is a 5 lakhs rupees, and the aircraft and the engines and all thing. Okay, goods imported also cost free of cost on re-export basis, then also it has been exempted. Then goods not exceeding say USD 1000 or equivalent and the value transaction exported to Myanmar, especially certain country wise also we have different treaties. So accordingly these are incorporated. For the Myanmar, say it is 1000 is there. So like this exemption provision is there. Accordingly you have to make the supply of these samples. Okay, waiver condition is there. Then from the foreign trade policy provisions, the export of samples and free charge of the goods shall be governed by this paragraph 2.6. 2.6 what it talks about: export of bona fide trade and technical samples of free exportable items shall be allowed without any limit. Without any limit they mentioned. But from the RBI also you have to refer, there is certain limits are there. But from the foreign trade policy point of view, there is of course there is no limit they mentioned, but conditions apply other provisions also. Okay. So an application for the export of samples exhibit which are restricted, if it is restricted items, then of course you require that as per the restricted item this is there, you have to require the license from the DGFT. Okay. Then export of gift provisions also they mentioned, not more than 5 lakhs as I told you. So that is what the RBI also talks about, the 5 lakhs. Gift no more than 5 lakhs you can export without you need to realize the A. Similarly, there is provisions for gift and spares or replacement of the goods. These also provisions are there in the foreign trade policy. Free of cost export for status holders. Status holders now they made up to annual limit of say 10 lakhs or 2% of the average annual export realization. They are allowed. The status holders sometime back I shown to you. There are 1 star, 2 star, 5 star, 4 star and 4 star and 5 stars like that is there. Up to 5 stars are there. Those are called status holders. Those status holders need not means that limit for this export, they can make 10 lakhs per annum or 2% of the average annual proceedings. They can export accordingly without EA, right? So that is why the conditions are there, various provisions are there under which you have to see. And again, UN and other things are there, then different provision is there. So particularly whenever you are making the export of the sample exports, you have to see all these provisions. The status holders, as per the RBI also, they made very clear provision for the EDF. Now it is EDF, as I told you, GR, that is incorporated in electronic filing. Then EDF filing they called. So there, that status holders, that as I told you, up to 2% or the 10 lakhs is the provision. Then banks can be asked to give that A provisions. This is also RBI circular. In the RBI circular also they're talking about annual say 10 lakhs and 2% of the actual. This is for the status holders. Through courier also you can send the samples, or through postals also you can send the samples, subject to, again, there is conditions. In courier, for example, the courier through this is 5 lakhs per consignment, that is the maximum limits. So accordingly you can make this export of the samples. Generally, whenever the updates are happening, not depend on any other things, updates you have to refer to the original, either the foreign trade policy or customs provisions or the RBI provisions. RBI provisions, of course, I will share to you. RBI provisions for master circulars, they used to publish master circulars. Master circulars you have to see. This is, for example, the master circular for export and export of goods and services. This is updated as in January 2021. Okay, so the master circular you have to see. As per the master circular, what are the provisions are there for export and what are the limitations? All these things are given here. You see, all these things are there for provisions, forfeiting, export factoring, and all these things also. Export project export, for example, you see, or service exports. So all the provisions are given here. Accordingly, you have to follow the provisions. Okay. Here, for example, we are seeing into foreign account diamond manner of receipt and payment. Example, I'll show you the export realization. You see, the realization and repatriation of the proceeds. Suppose you are making any export, within what period you have to means get the realization. That realization provisions they mention very clearly about the 9 months. And COVID period, of course, because of the looking into the COVID, they have made certain provisions during that time. That period is also they mentioned. Any exports happen, then it is a 15 months is relaxation is given. Otherwise, it is 9 months. 9 months you have to get the payments realization. In case of samples, you have to get the waiver so that you need not be get the realization. Otherwise, there is a condition that you should get the realization within that specified period. Okay. Similarly, for a EOU or a SEZ also there is a provision. There also they made the 9 months. There also they made in this provision, you see, SEZ or EOU or other units. Here also the 9 months. The 9 months is the standard provision. So within 9 months you have to get the realization. Otherwise, what are the benefits you are and means taken or you are claiming will be reversed. Suppose you are taken a duty drawback, the duty drawback amount has to be returned to the customs along with interest, because you had made a wrong claim or some conditions are not fulfilled. These are all provisions are subject to conditions. Condition fulfilled, then only allowed. So you have to return back. Similarly, suppose the refunds you have claimed, the refunds also you have to return back to the officials, right? So like this, you have to refer to the original provisions, what it talks about. In case of samples, as I told you, there are certain exemptions are provided. Accordingly, you have to see the exemptions. What is the provisions? What is the limits? The limits time to time they used to change. So updates you have to take. This is what we are talking about. Okay, now we are talking about the exhibits and samples. Samples we are sending directly is one aspect. The other one is exhibits. Exhibits means, for example, you are going to the foreign exhibitions carrying certain goods, or sending the goods for the exhibition purpose only. Then there are two conditions can happen, two possibilities are there. Mean, in the exhibition, some of the goods you must have sold, you may be selling also there in the exhibition, and some you may not be selling, you are bringing back. So what is the provisions that we are talking about here, right? As per the foreign trade policy, this foreign trade policy, except there's a prohibited item or so much items, other items also allowed to send for the export for the exhibition purpose. When you are sending an exhibition purpose, you have to make certain declaration. The foreign for the exhibition or exhibitions, fairs or similar shows to display for a period of 6 months. Of course, you can send, and within 6 months period, you have to re-import. Suppose you are exported, you have to re-import. Suppose you imported, then you have to re-export. Suppose certain times you are representing your foreign buyers, foreign customers, or foreign manufacturers, something you want to bring in import, then you'll show in your exhibition in India. Then within 6 months you have to export, also re-export same items. Otherwise, the customs duty is applicable. Similarly, when you are making this export, when you are saying making the export, so just a minute, sir. Let's call. Hello. Sorry, sir, there was call. So you can send for the exhibition, for example, outside India. Then you can send, make a declaration with customs along with the bond. Then you can send the goods, and you has to re-import within period of 6 months. That is as per the provisions here mentioned. And suppose you want to import for the exhibition in India, then you have to export, re-export whatever you are imported, same items have to re-export within a period of say 6 months. That is what they given. Okay. Suppose some items you are sold in overseas, for example, in outside the country, you are sold in the exhibition. Whatever you are sold, to that extent, that whatever you are sold, treated as an export, treated as an export. Okay. Because for that realization you have to show that conditions has to fulfill the realization. Whatever you sold there, the realization has to be through banking channel. you have to, or you have to make the remittance in the bank, so that you have prove that there you have sold the material. And whatever you are not sold, you can re-import, of course without payment of any duties, because you have to make a declaration that you are sending the goods outside the India for exhibition, and made a declaration to import it after that exhibition. But import happened only for some items, but other items you have sold already. Whatever you sold, that is treated in export, and what you are bringing back, on that there is no need for paying of import customs duty. Okay. Similarly, for whenever you are importing on declaration that for the exhibition, you need not pay the customs duty, but whenever you are exporting back to the other country, then you have to match this whatever you are imported under which invoice, and all these things you have to, which bill of entry, because you are imported first. On the bill of entry you have to declare in the shipping bill, all the declaration has to made, and you have to send back. And when these are been sent back or brought into India, you have to mention, means you have to observe one thing. Same material has to, for example, you are sending outside India for exhibition, when you are bringing back, the same material has to, what you have declared with this that's numbers or serial numbers or something, that has to match. Same material has to bring back, not some other material. So therefore that matching is one of the very important aspect, that marking or something you have to provide properly, so that you can show that marking. Yes, whenever you are sending to outside India, these are the marking, those marking you have to mention the shipping bill very clearly. So whenever importing, bringing back, again you can produce this shipping bill, these are been exported, and these again the same items you are bringing. That correlation is very much essential. Otherwise, if not able to declare these things and not so able to show, and harassment will happen, customs harassment. Okay. Because the purpose is, whatever you send, the same items are allowed to import, not something else. Okay. However, you see, however, sale exhibits of items are freely importable shall be allowed within a period of that year. If the goods bought for the set are not re-exported or sold within the bond period due to circumstances, then customs duty has to be paid. For import I am talking about, that is for the export, and for this import.
Required to pay custom duty, sir.
Pardon, sir?
Is it required to pay custom duty for sample and exhibition?
No, sir, that is what I am telling you, sir. Suppose one case we take separately, we take one is the export case, one is the import case. Suppose you are sent certain material outside of India for overseas exhibition. For overseas exhibition, in the exhibition you sold, for example, you send say 100 items, you sold some 40 items there, and 60 items you have to bring back. Then you are importing again the 60 items you are bringing. On that 60 items you need not pay any customs duty, because at the sending of the export you made a declaration that these are being sent for the exhibition purpose, and you have executed bond with customs officials also. And when you are importing, you have to prove that the same items what you are exported are being imported, so that matching has to be done. Then you can import without making any customs duty. So this is one case. The second case, suppose you are imported for exhibition in India from your overseas associate, you brought to India, and in exhibition you are exhibited, then within 6 months you have to re-export. And in the exhibition, for example, you sold certain items. To that extent, only those which we are sold in India, for that customs duty has to pay, and other items you can re-export without making any payment of the customs duty. Clear, sir? Clear, sir?
Sold sold case, when we need to pay the duty and file the bill of entry, is it prepared to file the bill of entry, or we need to pay the through TS challan duty payment?
No. That invoice, instead of invoice, we are making the challan, because
Okay.
this invoice is, when we are making the invoice, that the tax invoice. Tax invoice, whenever we making the tax invoice, there must be certain consideration. But here in this case, you are making the only delivery challan base. You can send it or you can receive it on the delivery challan basis only. There is no need for tax invoice,
Sold
because
cases actually.
there is no
Exhibition,
consideration. Yes, sir.
exhibition, we have sold out of 100, we have sold 40 item.
Hmm.
40, we have imported 100, out of 100 we have sold 40 items.
Ha,
40
ha, ha,
items
ha.
we need to pay
Hmm.
duty.
Yes, sir.
When we
Yes.
need to pay duty, at the time of sold the exhibition time, or at what point of sale will come, and when we need to file the bill of entry and the duty payment, when we need to happen.
Oh, one by one, let me explain. One first case we explain, when you are sending the goods outside India for exhibition in outside India. Okay, say 100 items you have sold, sent to outside India. You have filed the shipping bill under the bond declaration that I am going to bring back these items. Okay, then you exhibited there 40 items you have sold, and to that extent of the 40 items, as I told you, these are treated as an export. These are treated as an export. To that extent only you have to raise the tax invoice. To that extent you have to raise the tax invoice. And when you are sold, that consideration must be there, that he has to deposit through banking channel. So that is treated an export. The transaction has to be closed as per the realization of the payment. Then the balance 60 items you have to import into India, because you are not sold there, you are going to import. Then you have to file the bill of entry with the reference of the shipping bill, and those items which are sent, that identity also must be matched. And then you can import without payment of the customs duty, because your own items you are sent to export, means overseas, then you are bringing back. Therefore ATA conditions, under the ATA provision we call it, so under the ATA provisions there is no need for paying in any customs duty for that 60 items which are you are importing. Okay, this one transaction is over, this first case is over. The second case we are talking about, the second case, you are imported certain items and exhibited in India under the again condition that you have made a declaration within 60 days, these 6 months you want to send it back. In the Indian exhibition, these 100 items you are exhibited, suppose you sold say 40 items. To that extent of 40 items, you have to make the payment of the customs duty, and other 60 items you have to send it back to the, means again re-export to the original country. Okay, so this is the provisions.
But when we need to pay custom duty?
The customs duty, when you are made a sale, means within that 6 months period, that you have to make a declaration yourself, because
Okay.
within that 6 months period you are free. Anytime you make the declaration and sell. Generally a good practice is, whenever you are selling in India also, maybe you are selling through some transaction, some invoice and other thing, then to that extent you have to make the payment before that. Okay, so that is how the provision. Okay,
Thank you.
good. Now let us go to the provisions for the project import regulations. This is what we are talking about. Project import regulation, generally when you are putting a project, lot of machineries and other things required, lot of items you have to import certain times. Suppose you are going to import certain machineries or capital goods. Along with capital goods, some also associated accessories and spares and other thing also you are importing. And generally when you are importing, these accessories or the spares, each is a one item. As per the customs provisions, the machines may come into some decomposed means semi means decomposed or fully decomposed position. Means suppose so large machine is there, in one lot you can't bring, but you may be bringing several lots, 2-3 lots, or packs also, because it's not possible to export for the means import for the entire large machine. You are breaking down into smaller parts and then putting into the boxes. Then at the site only you are assembling. That is generally happens at the site assembly. Okay. So whenever you are importing these different items, customs takes for each of the items under separate headings. For example, some spares, as I told you, some spares are made of say stainless steel. Some spares are made of, for example, brass, or some spares are made of aluminum, or some rubber, or some, plastic. Different classifications then it comes under. Different items comes under different classifications. The machines also comes under different classifications. So therefore, it is very tedious assignment. Say hundreds of spares are there. Each of the spare you have to assess with under which classification. Then accordingly you have to make the rates are applicable for as per the tariff headings. As per the tariff headings, the rates are applicable. Customs duty rates are applicable. So this making is very tedious and certain times becomes impossible also, and highly time consuming. So therefore, there is a provision they made under this project import regulations 1986. Under this provision, a single classification is been provided, a single classification under the heading of 1998.01 of the Customs Tariff Act. Under this provision, only single classification, so that it attracts only single duty, single rate of duty. There's no multiple provisions are there, multiple rates and other thing. All the machinery and its associated declarations about the spares, about the various other components or associated accessories, all these things clubbed together, you can declare as one means classification under this heading of 98.01. Okay. Therefore, you can have a very clarity about the import and what the payment of the customs duty has to pay, also very clear. Okay. So for this, there's a provision in there in the customs. You have to register under the project import with the customs. A declaration has to be made, and you have to declare with the customs provision that you are making this import under the project import. That registration is a mandatory requirement. You have to register it. Okay. So what are they allowed under this project imports? Also, you see the prime movers, instruments, apparatus and applications, control gears, transmission equipment, auxiliary equipment, and all components. Again, they mention all components. All the imported capital goods, like these things are these are machinery. Yeah, they told the machinery includes this, and other machines also allowed, and also the components. What are all the components? Are raw materials for the manufacture of the aforesaid items. These are all allowed as a and includes the spare parts and other raw materials. You see, and of course certain consumables and other thing not exceeding 10% of the value. This is these consumables and some raw material semi-finished goods. These should not be exceeding the 10% of the value. Okay. Under this, you can be allowed to make the industrial plants, irrigation projects, power plants, mining projects, or other projects. These all can be allowed under these provisions. Okay. And under this, what is the registration? First is the procedure we are talking about. First is registration of the contract. What are the, you have a contract with the overseas supplier that you have to register with the customs as per the regulation 4 of the provisions. You have to register first. That is the first. Then customs formalities, bond registration, bond also you have to execute. The bond has to be executed. Then you have to file the bill of entry with a declaration about this bond and other provisions. Then clearance of the goods happens after the registration only. Then finalization of the contract is another step, is finalization of the contract. Finalization of the contract means after the import, whether you are, means that where you are using, that all those things you have to declare to the customs. Okay, which place you are installing this machine or using this machine, these things are you have to declare. So under this provision, therefore the final contract has to be made, so that either the chartered engineer or the concerned authorities has to verify whether you have done this or not. The reconciliation statement by the importer within 3 months has to be submitted to the customs authorities. Okay, plant site verification can happen. Otherwise you have to make the chartered accountant declaration saying that these machines are being installed within your that plant or premises. Provisional assessments also allowed. If it's exceeding, then provisional assessment also allowed. Otherwise this finalization of the contract is a very essential. So these 4 steps you have to follow. First is the registration of the contract, then the bond or execution, then about the filing of the bill of entry with all the declarations and corresponding documents, and this means so that registration details also must be mentioned in the bill of entry. And then finalization after the import, within that 3 months you have to make the declaration, and reconciliation statement has to be made. Okay.
Sir, what is the timeline for installation of machinery after importing on the projects?
Project import, the 3 months this reconciliation has to be made. Within 6 months you have to make this proof. Either you have to give the chartered engineer certificate, and reconciliation has to be made and close. Otherwise these are not treated as a import under the project import provisions. Then they will make the installation and commission. Installation has to be made now, sir. That installation certificate, installation certificate is a mandatory requirement. Then only the finalization of the contract happens. The bond, means provisions under this, can be finalized only when you have made installation and the reconciliation statement is submitted. Then it is a matter closes. Otherwise this is one concessional provision like to you. Otherwise the assessment has to be done on various other chapter headings, tariff headings. Therefore it is a maybe different also, maybe certain higher amount also. Suppose the machines you are importing under 10%, and certain items, for example, it may be some more, maybe 20% custom duty. In such case, the differential and other things you are liable to pay. This is the concessions is allowed to you, and ease of doing also for import. So whenever this condition, means concession provided, certain conditions you have to fulfill. That condition is, yes sir.
Under EOU also we can opt for this project imports.
Why you do under EOU, sir? Anyhow EOU is allowed now, sir, and separately you need not go for the project import provisions. There everything is clear, means without payment of the duty is allowed. Then why you go with the project import, then pay the duty of 10% of the customs duty? Not necessary, no. There it is allowed free of cost. So here in the project import there is no free of cost. So
Okay,
the project import is provision is classification benefit. Classification benefit is a major advantage of it, because hundreds of items comes, all these things individually you need not make the declarations. So a single declaration under the chapter heading of 98.01 you can make, then make the clearance.
Sir, you don't mind. Can you brief about mover? How to
Okay.
mover registration, how to practical things.
Okay, that is on the Sunday we have the 2 lessons last days, so I will cover that one specially. Okay.
And sir, one more Monday again I am requesting you. We are
Sir, on
only
time,
section 1,
sir,
section 1
time to
and
time.
section 2.
Sir,
Section
time to
100
time, sir,
only
true,
people.
time to time, and true, Baba, true. And time to time, what are the possible? Definitely, I will share you. Told you, no. I will share you what are the possible. All the things I will share to you. Okay, good, good.
Thank you.
So my request is go to the provisions from the original, not to the any other some other sites and all thing. Go to the original site like DGFT. Mean DGFT site you go, then see the what are the provisions are there in foreign trade policy or for handbook of procedures and other things. Similarly, when you're referring with the customs site, you can go and search, or exactly notification you have to see. Similarly, RBI, that RBI notification and nothing has shown to you, like that you have to go to the RBI notification, then you can see what is the provisions exactly, you know. But otherwise, in internet searching, many people have many versions and they can give their own comments. Then you may be biased and coming to other conclusions. That is not good. As a professionals, what we have to do is we have to go to the original, that bare act or the original provisions only we have to refer. Okay. Okay, sir. With this today's session, we are going to close.